In today's interconnected global economy, the flow of goods, services, and capital across borders is the backbone of prosperity for nations worldwide. The United States, as the world's largest economy, plays a critical role in this intricate web of trade. American-made products, from cars to technology, agricultural goods to industrial machinery, reach consumers on every continent. But what if this vital flow of goods was suddenly disrupted? What if other countries, angered by US tariffs and trade policies, decided to stop buying American products entirely as a form of economic retaliation? This scenario, while extreme, highlights the delicate balance of international trade and the potentially devastating consequences of protectionist policies. Tariffs are taxes imposed on imported goods designed to protect domestic industries by making foreign products more expensive. However, when the US imposes tariffs, other countries often retaliate by slapping tariffs on American exports. This tit-for-tat dynamic can escalate into trade wars, disrupting markets and hurting businesses on both sides. In this hypothetical scenario, retaliation goes a step further. Instead of imposing tariffs, countries collectively choose to boycott American goods altogether. They turn their backs on US exports, refusing to buy, import, or sell American-made products. The consequences for the US economy and global trade would be enormous and complex. The first impact would be immediate and visible in the US manufacturing sector. American companies that rely heavily on exports, such as those in aerospace, agriculture, automotive, and technology, would face a sudden collapse in foreign demand. Products that once filled cargo ships bound for overseas ports would pile up in warehouses, causing supply gluts and forcing companies to cut back on production. Factories would slow down or shut their doors, leading to widespread layoffs. Workers in export-dependent industries would be among the hardest hit. Agriculture, a major US export sector, would suffer devastating effects. The US is one of the world's largest exporters of soybeans, corn, wheat, and meat products. Many foreign buyers, including China, Mexico, and the European Union, rely on American agricultural products to feed their populations and sustain livestock. A coordinated boycott would force American farmers to find new buyers or sell their goods domestically at lower prices. This oversupply in domestic markets could crash farm incomes, leading to bankruptcies and rural economic decline. The loss of export markets would ripple through supply chains across the country. Companies that provide raw materials, parts, and services to exporters would see reduced orders. Transportation firms, ports, and logistics companies would also experience steep declines in business. The economic downturn in export sectors could spread to unrelated industries due to reduced consumer spending and increased unemployment. The multiplier effect would deepen the recessionary impact across the US economy. Consumers in the United States might initially feel insulated from this foreign boycott. After all, tariffs are meant to protect domestic producers, so Americans might expect cheaper or more abundant goods at home. However, the reality would be more complicated. Companies facing collapsing export sales would need to cut costs or raise prices to stay afloat. Reduced revenues could translate into higher prices for American consumers, especially if companies try to recoup losses by raising prices domestically. Furthermore, the value of the US dollar might fall due to reduced foreign investment and trade deficits, causing imported goods to become more expensive. Inflation could rise, hurting consumers' purchasing power. In the financial markets, the reaction could be swift and severe. Stock prices of export-heavy companies would plummet, triggering broader market declines. Investor confidence would waver as the US economy shows signs of weakening. Bond yields might spike as investors demand higher returns to compensate for increased risk, pushing up borrowing costs for both companies and the government. This financial turmoil could lead to tightened credit conditions, making it harder for businesses and consumers to get loans. The US government's fiscal position would also worsen. Export taxes and tariffs contribute significant revenue, but more importantly, a strong export sector supports overall tax income through business profits and wages. With exports tanking, tax revenues would decline, potentially increasing the budget deficit. The government might respond with stimulus measures or bailouts, increasing public debt and raising concerns about fiscal sustainability. Internationally, the boycott would shift global trade patterns dramatically. Countries that stop buying U.S. goods would seek alternative suppliers, accelerating the growth of other manufacturing hubs like China, the European Union, India, and Southeast Asian nations. Over time, these countries could strengthen their domestic industries, reducing their dependence on American products. The U.S.'s loss of market share in key sectors could have long-lasting effects on its industrial competitiveness. Moreover, this retaliatory boycott could weaken the global position of the U.S. dollar. Currently, the dollar serves as the world's primary reserve currency, supported in part by demand for U.S. goods, services, and debt. Reduced foreign trade and investment flows could prompt some countries to diversify their reserves into other currencies or assets. This shift would increase borrowing costs for the U.S. and reduce its economic influence worldwide. Politically, the boycott could exacerbate divisions within the U.S. The hardest-hit states would likely be those with large export industries, such as Texas, California, Michigan, and Iowa. Job losses and economic decline could fuel anti-trade and populist movements, putting pressure on politicians to reverse tariffs or negotiate new trade agreements. At the same time, some sectors might double down on protectionism, blaming foreign retaliation for their struggles. This could create a vicious cycle of escalating trade barriers and economic damage. The social consequences would be profound as well. Workers displaced by factory closures and farm bankruptcies might struggle to find new employment, especially in regions without diverse economies. The increase in unemployment could lead to higher rates of poverty, substance abuse, and mental health problems. Rural communities dependent on agriculture could be devastated, contributing to wider economic inequality. One might wonder whether this scenario is realistic. Would countries really band together to boycott U.S. goods entirely? History suggests that coordinated, comprehensive boycotts are difficult to sustain. Economic interdependence means countries also benefit from buying American goods and services. However, partial boycotts, targeted bans, or prolonged trade wars are not uncommon, and they can still cause significant damage. The recent tariff disputes between the U.S. and China, for example, have already hurt businesses on both sides in unsettled global markets. Technology and innovation sectors would face unique challenges. American companies leading in semiconductors, software, aerospace, and biotech rely on global supply chains and customers worldwide. A boycott could stifle research and development by cutting off revenues needed for investment. Additionally, the flow of ideas and collaboration could slow if countries close off access to American technology or intellectual property. The U.S. might lose its edge in critical industries, ceding leadership to rivals. At the consumer level worldwide, the boycott could have mixed effects. On one hand, consumers in other countries would need to switch to alternative products, sometimes less advanced or more expensive, while companies ramp up domestic production. On the other hand, they might discover new favorites from emerging markets. This diversification could foster innovation outside the U.S. and reduce global reliance on a single supplier. Trade retaliation could also drive countries to form tighter economic blocs or regional alliances, excluding the U.S. Such blocs could negotiate preferential trade deals, standardize regulations, and create integrated supply chains that bypass America. The fragmentation of the global trading system could reduce efficiency and raise costs, slowing economic growth worldwide. Energy markets could be another area of disruption. The U.S. is a major exporter of oil, natural gas, and energy technology. A boycott could push importing countries to find alternative suppliers, boosting rivals like Russia, Saudi Arabia, or emerging producers. Over time, this shift could weaken U.S. energy companies and reduce America's geopolitical leverage tied to energy exports. Agricultural policy and food security would become pressing issues. Farmers facing export losses might lobby for government support, but prolonged downturns could lead to underinvestment in agriculture. Countries dependent on U.S. food exports might struggle to replace supplies, leading to price volatility and even shortages. Food insecurity in vulnerable regions could worsen, fueling instability and migration pressures. The cultural impact of a global boycott would be less obvious but still significant. American brands and products have long been symbols of cultural influence and soft power. If consumers worldwide reject U.S. goods, it could erode America's cultural presence abroad. This loss of soft power might reduce the country's ability to shape global norms, values, and diplomacy. In response to such a crisis, the U.S. government might pursue aggressive diplomatic and trade strategies. Negotiations to reduce tariffs, improve trade relations, and rebuild trust would become priorities. Alternatively, the government could escalate protectionism, doubling down on tariffs and subsidies to shield domestic industries. The path chosen would determine whether the U.S. recovers or spirals into prolonged economic isolation. Another likely consequence is innovation in domestic consumption. As export markets vanish, U.S. companies would focus more on American consumers. This could lead to product diversification, quality improvements, or pricing adjustments to maintain market share at home. However, with a shrinking global market, growth opportunities would be limited, potentially curbing overall economic dynamism. The financial sector would face turbulence as well. U.S. banks, investment firms, and insurers rely on global trade and business. Reduced exports could lead to lower profits and increased loan defaults in affected industries. Financial centers like New York might lose prominence to other global hubs as capital flows shift. Regulatory bodies would need to manage increased risks in an unstable economic environment. A boycott could also affect immigration and labor markets. Declining export industries might reduce demand for specialized workers, while unemployment could trigger internal migration. Conversely, industries less affected by trade disruptions might attract workers, reshaping regional economies. Social tensions could increase as communities adjust to changing economic realities. Environmental consequences of the boycott are complex. On one hand, reduced production and shipping could lower carbon emissions temporarily. On the other hand, shifting manufacturing to countries with lower environmental standards might increase pollution globally. Additionally, increased domestic production could strain local resources and infrastructure. The net effect would depend on policy choices and technological adoption. Education and workforce development would need to adapt. As industries shrink or shift, retraining displaced workers would be essential to reduce unemployment and poverty. The government and private sector would need to invest heavily in skills development to help workers transition into emerging sectors or services less vulnerable to trade retaliation. The role of technology in mitigating some negative effects cannot be overstated. Automation, AI, and digital services could help businesses reduce costs and maintain competitiveness despite shrinking export markets. However, these technologies might also accelerate job losses, especially in manufacturing, exacerbating social challenges. Balancing innovation with inclusive growth would become a critical policy focus. Geopolitically, the boycott would mark a significant realignment. The U.S. might find itself isolated from allies or trading partners, unwilling to risk economic backlash. Rival powers could exploit the situation to expand influence, form new alliances, and reshape global institutions. The U.S.'s traditional role as a leader in international economic organizations could diminish. At the same time, domestic political divisions could deepen. Trade policy has long been a contentious issue, with some advocating for protectionism to defend jobs and others warning against the risks of isolation. A full-scale export boycott would intensify these debates, potentially influencing elections and government stability. Looking decades ahead, the long-term effects could be profound. The loss of global markets might force a fundamental restructuring of the U.S. economy. Some sectors might never regain their previous scale, while others could emerge stronger by focusing on domestic innovation or niche markets. The country's position in the global economy would likely decline relative to rising powers that capture the markets abandoned by the U.S. In conclusion, a scenario where countries stop buying American goods in retaliation for tariffs is a stark reminder of the interconnectedness and fragility of global trade. The economic fallout would ripple through industries, communities, and financial markets while reshaping geopolitics and culture. It would challenge policymakers to balance domestic interests with global cooperation and to find pathways back from economic isolation. While such a comprehensive boycott is improbable, ongoing trade tensions and tariff disputes continue to threaten this delicate balance. Understanding the potential consequences helps us appreciate the value of open, fair trade and the risks of protectionism spiraling into economic retaliation. The future of American prosperity is deeply tied to its ability to engage constructively with the world, avoiding the pitfalls of economic conflict and fostering cooperation in a complex, interdependent world.